I think that if you look at when the big downdraft was earlier in October, it was during this vacuum of information about companies. And now that we're seeing the numbers come in, stocks follow earnings. Earnings are still pretty strong, as we've seen all year. First quarter, second quarter, over 20%. So far, we're looking 20%, but as Dominic says, it's still very early days. But stocks will follow earnings, and now that the numbers are coming in and we're getting more tangible evidence of what's happening, I think the market can relax a little bit.
Brian, that may be the case for the short term if we're looking at this over the next month or so as we get a lot of these reports. But all of these other worries, we don't worry about until we do. And all of a sudden, when the market doesn't have something else to focus on, those fundamentals, they kind of come back and they're overwhelming. You expect that cycle to happen again?
I remember a story a few years ago. A study came out said that all of the gains on the S&P 500 were happening around FOMC days. Fortunately, that's not happening anymore. But now all the gains in the FOMC are happening in earnings season. So earnings season needs to stay positive. We know going into the next couple of quarters, we expect to see positive growth, but there's going to be a pretty sharp deceleration once the effect of the tax cuts wears down. We see rising labor costs, rising input costs. So instead of this 20 or 25% earnings world, we may be in a 8 to 10% earnings world next year, and that might not be as supportive for stocks.
Are we in a position where a lot of the declines are coming around the FOMC, maybe not on the day, but it's Fed speak for sure that has driven the markets down?
It may also just be that the Fed is meeting in these earnings vacuum periods, too, where the markets are sort of reeling for reasons that don't have much to do with the Fed, but the Fed has certainly in the past been sort of setting off alarm bells with raising the dot plot or coming out with a more hawkish forecast. And certainly in the month, late in September, early October, it seemed like the Fed did have a tangible impact.
Ellen, how do you try and figure out how much of the market's movement is going to be related to what you're hearing from Jay Powell or other Fed officials versus how much is going to be based on fundamentals? Or is it just matter on what the calendar says?
It really is just a matter of what day it is, Becky. The market responds to whatever is in the news that day, and some days it's earnings and some days it's the FOMC. But to Brian's point on the deceleration for next year, last year the market was up almost 22%. And guess what? This year earnings are up over 20%. Next year, the forecast is for earnings to be up 8 to 10%. You might end up with an 8 to 10% year this year. We're at 6.5 now. And the market tends to be a forecasting mechanism. And so it wouldn't be surprising to see the market end up in the mid to high single digits for this year as it's looking forward to 2019 earnings.
That's a really interesting point. What Dom has been bringing up, this idea of tariffs being mentioned, again, we're trying to get a measurement of how much of an impact that has if it's something that's a big player. Is it something that's really hit your radar screens to this point, or do you still look at it as background noise?
It is increasing in importance. It's still early days. And not only is it early in earnings season now, but in addition to that, the tariff impact won't be felt immediately because some companies bought ahead. There were some inventories that were built up. Some companies may have had some cushion. And so we may not see the full effect until it's been in effect for more than the time that it has so far.
So we're still waiting to see the boogeyman, essentially?
I think it could be another quarter before we begin to see really meaningful impacts reported in these company earnings reports.
Brian, what do you think?
More worried about the tariffs that are yet to come. If we see the rate on the $200 billion go from 10 to 25%, that seems very likely to happen. And the last $267 billion worth of imported goods from China, if that gets taxed early next year, if the trade war kind of continues to escalate between the U.S. and China, that starts to hit a lot more kind of consumer retail goods. That can affect consumer confidence. You don't even need to see a large dollar impact for the sentiment to be negative.
Consumer companies like Costco have said they don't see a huge impact necessarily, that they could weather it better than others. So who would be at risk?
The goods that have been taxed so far don't tend to be goods that consumers are seeing in stores. But at that last $267 billion, now you're talking about apparel, you're talking about technology, cell phones. Those are things that people could absorb, and you can see higher CPI, lower consumer confidence, and lower earnings for retailers.
I would say this. One of the things that we did notice in the marketplace over the course of the last couple of weeks with the market stresses is that a lot of the outperformers have been U.S. consumer-focused retailers. So you're talking about names like Dollar Tree, you're talking about names like Kohl's or a Nordstrom, even on the high-end side of things. So as we talk about the effect of tariffs, there may be a view among some investors that they are going to play it by looking at more U.S.-centric, either mid-cap or larger-cap multi-line retailers, because the American consumer is still viewed as being relatively strong compared to other consumers around the world.